Well, this week we'll get a key piece of data that the markets are hoping will give any insight into whether or not the Fed has the room to cut rates. So far in the months leading up to this, inflation has consistently surprised to the upside. But recently, we've gotten weaker sentiment data. We got weaker than expected job growth. Could inflation also grow less than expected? And what does this mean for the Fed? Let's bring in Mary Ann Bartels, who's the Chief Investment Strategy at Sanctuary Wealth. Mary Ann, thanks so much for joining us. So how are you playing this one? How are you thinking about what the data might say and what the Fed might do?
Well, what we always tell our clients, really what drives stock prices on a sustainable level is earnings. And earnings have come in very strong or better than expected. But they're not abundant. They're still very concentrated in the Magnificent Seven. But if you take out some of our pharmaceutical companies that have actually reported bad numbers, earnings are actually up almost 10%. So those are the key drivers. But if we get a soft PPI number and a soft CPI and a PPI number, we think that could be a catalyst to eventually allowing equities to hit record all-time highs. So what we're really telling clients is we do think that we're in the peaking cycle for interest rates. We think interest rates for this cycle have peaked. We may have some volatility, but we are looking for new record highs in the equity market for the summer.
Higher than what we've already seen, because we hit a bunch of them earlier this year. What kind of upside are you looking for?
So for the year, we're actually forecasting that the S&P can hit a range of around 5,600 to 5,800. So at least another 10% upside is what we think our markets can do here.
So another 20% year for the S&P 500, and that's all powered by earnings growth?
Well, earnings are very important to that, but really liquidity has been the main driver. We still are running on the liquidity that the Fed stimulated during COVID and having zero interest rates. But our President Biden, signed 3 pieces of major legislation that are stimulating our economy by $3 trillion, a level that we never see when we're actually growing our economy. In fact, if you look at the GDP now tracker by the Atlanta Fed, it's estimating that our growth rate is running around 4%. It's not an official forecast. Our economy is doing very well. We are not in a recession, nor do we think we're going to be in a recession. So it's very unusual to have all of this stimulus. We also wouldn't be surprised if we get soft inflation numbers. We think the Fed is going to try to lower rates at least once before the election. That's stimulative. Their balance sheet, they announced in their last meeting they were going from 60 billion down to 25 billion. That's a form of stimulus. A lot of liquidity that we think will go into risk assets.
I guess I'm trying to understand how this stimulus isn't inflationary and thus keeps the Fed, prevents the Fed from cutting rates.
Well, if inflation remains sticky, they're not going to be able to cut rates. So if inflation comes in a little bit hotter, we would not expect the Fed to be able to have room to cut rates. But should they find a window where they can cut rates, we think they will. But I think what's really more important is that we think the interest rate cycle has peaked. We don't think we're going to hit new highs this cycle in rates. And when we look at the cash on the sidelines, there's $6 trillion here in cash. And, cash here is earning about 5.5%. So if interest rates do start coming down, we think even that part of that liquidity can find its way into risk assets, and part of that actually go into the equity markets.
A lot of, because you said so much of your guiding light is what earnings are telling you, that the growth is still very much there. The forecast for growth in 2025 is for about 14% earnings growth. I've heard some say that, that's way too optimistic because we are going to see a slowdown. Would then, given your lens and your view, say that's not overly optimistic at all?
Well, it's kind of early in the cycle. And I think what analysts are still trying to put into their numbers is, how do you factor in artificial intelligence? I think analysts are still trying to figure out, is there a productivity enhancement that will come from AI? And when will that happen? And I hear different things from different people. It could be a good number if we begin getting productivity enhancements. But that's still quite a whiles away. I'm still trying to get through this quarter and next quarter. What I'm very positive on, however, is that we remain in a secular bull market, meaning I think the trend is going to stay positive. I think for another 5 years, we'll probably have another bear market, but I'm not looking for a major cycle peak in our longer term work until 2029, 2030.
What do you think of this meme craze?
Which, I'm sorry, what kind of craze?
The meme craze, that you see these things going gangbusters on a single day.
Yeah, to be very honest, I really don't pay attention to it. And I understand some people are very passionate about it. To me, there's no leading indicator. That is more, that tends to be very emotional. So that's not a great driving factor that I'm watching. But one driving factor that's not getting a lot of airplay, which I'm actually surprised, is our advanced decline line, or what we call the breadth of our market, on Friday reached a record all-time high. And, people have been concerned about the concentration in our market. That is not the case. We've seen a significant broadening out. We've seen it in industrials, energy, now utilities. So that is a confirmation that the trend in the market this year remains positive, and it also indicates we're going to new highs in the S&P 500.
And what does that mean for you? Let's bring it all down in terms of positioning. Where are you most exposed in the market to capture that upside?
Well, I like to follow earnings, and earnings are really in the AI companies, the Magnificent Seven. So we are very overweight technology. I have been a fan of semiconductors. I remain a fan of semiconductors. You can't have artificial intelligence without the semiconductor chip. Because of all this stimulus coming from our government, infrastructure and the infrastructure to build out AI is going to be enormous. So we like the industrial space there, and you're going to see some utilities also benefit from that. And don't count our consumer out. Our consumer is still strong, very bifurcated. The low end is not strong, really impacted by inflation, but the consumer actually has money. That cash on the sidelines is earning 5%. When we look at household net worth, it reached a record all-time high. So we still think that there's a lot of positives on the consumer side.